Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in this video I'm going to share with you guys 5 sleep well at night kind of stocks. What I mean by that is every single one of these companies pays dividends. Every single one of these companies has a basically growing revenue, has been around for a very long time. They have a wide economic moat, so that means they have a competitive in terms of the competition, in terms of companies out there. They're the best company in that sector, if you like, or in that industry. And this is the type of business that you can buy today and forget about it. That's it. I've done that. I own majority of the companies that we're going to talk about today, so I'm going to share with you guys those 5 companies. But before we do that, as always, just press that like button because it makes a huge difference to me. And also, if you can join us at the Patreon account, it will be absolutely amazing, where you get access to the Discord, where a lot of brothers are sharing very good practices. You get regular updates from all the buys and sales that I make on this portfolio, as well as the family portfolio, and you get access to the basically the monthly high quality stocks that are undervalued. You got so many things out of it. So just try it out, inshallah, for 1 month, and if you like it, of course, you stay with us. That's it. Now what I'm going to do is I'm going to share with you guys for the 5 companies. Each one of the companies I will go through in turns, and I will talk about these important information here. First part, we're just going to talk about the dividend side of things, because we said that all of these companies pay dividends. We want to see if the company has a growing revenue, so the compound annual growth rate for the revenue, for the EPS, which are important. So it kind of gives us an idea where the company has been over the last 5 years. Then we want to look at how good the management is. Okay, so we want to see the profit, basically margins. So based on their revenue, how much profit are they making, and so on. The return on equity and the return on invested capital will help us understand if the current management is actually doing a good job in terms of taking the capital they have and doing something with it to generate more profits. Basically, we want to see if the company has a free cash flow, and free cash flow is used to of course buy back any shares that the company, outstanding shares the company has, of course, pay debt, pay off any debt that the company has, pay dividends. There's a lot of things that they can do with that. Okay, of course, it's growing the business side of things, so they can acquire other businesses. And then we want to see the free cash flow yields, just to kind of get an idea of where that free cash flow has been, basically spin. Total return the last 10 years. We want to see the capital, basically the total returns, not capital, total returns over the last 10 years, which is basically price as well as the dividend. So price appreciation plus the dividend, where the company has been, what was the total returns per annum. Then we want to see where the company is heading next year. Okay, so the revenue growth for the next year, and then EPS for the next year. Then current valuations according to Morningstar. And like I always say to you guys, I use Morningstar because I genuinely feel like they are quite conservative in terms of their basically the models that they use and so on, and basically it gives us a little bit of a margin of safety, if you like. So what I'm going to do is I'm going to reveal all the companies. We'll go through each one of them, and then I'm going to show you back test these companies. We want to see where the companies has been over the last 10 years. So we'll see the total returns for collectively. Then we're going to back test the entire portfolio. Say if you had this portfolio for the last 10 years, we want to see if you started with £10,000 and you have at the end basically what you have over the basically how much the company, I can't even talk, how much the portfolio has basically grown over the last 10 years. So you invest in £10,000, 20% each company, and then we will backtest that, inshallah. So let's get on with the video. If you haven't pressed that like button, please do so. It really makes a massive difference. So first company is Automatic Data Processing. This is one of the companies that I own. 124 billion market cap right now. It has a wide economic moat, and current price is over $300 per share. Dividend yield of 2%. The payout ratio is almost 60%, and the 5-year growth rate 12%. Dividend streak is for 25 years. Annually they pay you $6.16. Dividend safety of A-. Okay, and 5-year growth rate of 6%. In terms of revenue, in terms of EPS, about 14%. Profit margin, return on equity, and return invested capital, really good. In terms of free cash flow, looking at over $4 billion, and free cash flow yield of 3%. Now, total return the last 10 years, company has returned about 15% per annum. Revenue growth for the next year is expecting about 6%. EPS about 9%, fairly valued right now. $280 per share is where they think the price should be. Right now, as you can see, just over $300 per share. Now, if we look at the year to date where the company has been, it's about 30% up, which is quite a lot for this company. And when you would look at the Wall Street analyst ratings, for example, we got 2 strong buys, 2 buys, 14 holds, 1 sell. And as you can see here, right, $298 per share where they think the price should be. That is a basic downside about 1.5%. The next company we're looking at today is S&P Global. This is a rating company. Again, another one that I own in my portfolio. Almost 160 billion market cap, wide economic mode, current price $517 per share, dividend yield of 0.71. So it's quite low, but the payout ratio is very, very low, which means that you can increase that dividend if they need to in the next couple of years. The 5-year growth rate of just 10%, which is absolutely amazing. Double digits growth in terms of the last 10 years. Growth as basically the dividend streak is about 50 years. So that means they are dividend king. The annual payout, we're looking at $3.64. Dividend safety of basically right now is A. The 5-year growth rate is 16% in terms of revenue, and EPS about 7%. Profit margin, return on equity, and return on invested capital, absolutely nothing to worry about. Free cash flow is amazing. The free cash flow yield is over 3%. Total return the last 10 years, we're looking at about 19%. Growth estimate next year is 6%. Growth estimate for the revenue side of things. And then next EPS, we're looking at about 10%. Now, 7% premium right now. I'm going to change the color, this one. Just kind of color code. So 7% premium right now. So it's 7% higher than where they think it should be. It's about $480 per share. Right now, just over $500 per share. Now, if we look at morning Seeking Alpha, it's actually Wall Street saying it's a strong buy. We've got 13 strong buys, 7 buys, 2 holds, no sales whatsoever. And we have $575 per share, 11% upside from where we are currently, which is very interesting in comparison to this one here. Is although it's saying the 7%, this is what I mean. Wall Street slightly bullish in comparison to basically Seeking out Morningstar valuations. Okay. Next one is Visa, another company that I own that's definitely Sharia compliant, has nothing to do with credit side of things. This company facilitates the transactions. They are a technology company, 607 billion market cap right now, wide economic moat. In terms of price, we're looking about over $300 per share right now. Dividend yield of 0.76. Payout ratio. One of the things that you will notice for this some of these companies, the basically the current dividend yield is quite low, but the payout ratio is so low, and they are growing it massively, which is quite nice. Now, in terms, they have been increasing this dividend for 16 years, $2.36. Basically, what you will get. Dividend safety is A right now. The 5-year growth rate 10% when it comes to revenue. EPS 14%. Profit margin, return on equity, return on invested capital. By far, one of the best companies in the market. Okay, one of the genuinely the best market, basically companies on the market. Free cash flow right now over $18 billion. Free cash flow yield of 3%. Total return the last 10 years about 18%. Growth estimate next year when it comes to EPS, we're looking about 10%. When it comes to revenue, 10%, 13% for EPS. 14% premium right now, $272 per share is where they think the price should be. Now, looking at Seeking Alpha, as you can see, Wall Street is actually saying 18 strong buys, 11 buys, 9 holds. And they think $321 per share is where they think the price should be. That's about 3%, 3% upside from where we are right now. Right, next one, that is Home Depot, another company that I own in this portfolio. Home Depot is one of the best when it comes to that side of things, with like anything to do with home improvement side of things. They deal with the normal DIY kind of things as well as professionals. So just like everyone, just like us, as well as the professionals, whereas Lowe's normally deals with just not professionals. 417 billion market cap, wide economic moat, $426 per share, dividend yield of 2%. Now the payout ratio is slightly high, 60% right now. The 5-year growth rate, but it's 12%, which is really good. 14 years of increasing, $9 is what you will get. A+ when it comes to the dividend safety. So the 5-year growth rate is 7% for EPS, and when it comes to revenue, and when it comes to EPS, it was about 10%. Profit margin, return on equity, return on invested capital, again one of the best out there. Free cash flow right now $16.6 billion of free cash flow. Yield is right now 4%. Total return in the last 10 years 17%. They're expecting the revenue to grow about 4% and EPS to grow also 4% in the next year. 44% premium right now. When it comes to Morningstar, I've never seen this company almost Apart from this time I started buying, I've never seen this company actually undervalued. And as you can see, it's a $292 per share. Now looking at Mods and Seeking Alpha, as you can see, we've got 21 strong buys, 5 buys, 12 holds, 2 strong sales, and $428 per share. That's flat right now. Exactly, that's where we are now. So yeah, again, they think it is basically right now undervalued or fairly valued, but according to Morningstar, it's not. But I genuinely think it is slightly expensive right now. The next one and the final one is Union Pacific Corporation. Is another company that I own in this portfolio. Railroad companies, one of the oldest companies out there. 146 billion market cap, wide economic moat, $246 per share. Dividend yield really nice, 2.2%. The payout ratio is quite low, 48%. The 5-year growth rate of 8%. Dividend streak of 17 years, and $5.36 is what you will get. A rated when it comes to dividend safety. The 5-year growth rate and the EPS are not great when it comes to revenue and EPS, but it's getting better, and I think with the new CEO, I'm hoping that in the next 10 years it will get better. Profit margin 27%, profit return on equity and return on invested capital really good. 5.5% when it $1 billion of free cash flow right now, 4% when it comes to the free cash flow yield. Total return in the last 10 years, we're looking at about 9%. Revenue growth for next year, they're expecting about 4%. EPS, they're expecting about 11% premium right now. $218 per share is where they think the price should be. And checking this on Seeking Alpha, as you can see here, we have a buy rating, 12 strong buys, 4 buys, 14 holds, and 256, about 4% upside from where we are right now. So as you can see, majority of these companies are right now is basically trading slightly higher when it comes to Morningstar. When it comes to Seeking Alpha, it's slightly lower. It's basically, they think basically some of them are undervalued at the moment, and they've got a bit of an upside. Now let's do 2 more things. Okay, so the first one is just basically kind of back testing to see the total returns basically for this company in comparison to the S&P 500 over the last basically 5 years. As you can see, basically Union Pacific is the lowest, 53, so it's actually underperforming the S&P 500, but the rest of them are actually, majority of them anyway, are over basically better performing when it comes to against the S&P 500. So I was surprised to see Visa is about 40%, the S&P 500 about 91% for the last 5 years when we look at the total returns. But when you look at 10 years, okay, this one is slightly underperforming. The rest of them are beating the S&P 500 massively. This is less than 200. The S&P 500 has performed 188%. And then you've got 374, 442, 414, and 508%. But the slightly Union Pacific is the one that underperformed slightly. So if you hold this company for the last 10 years, where would you be? If you started with 10, from 2014 to 2024, if you invested basically $10,000 or pounds or whatever, you have not added any additional money, you just reinvested your dividends, you bought all of the companies and you put 20% each, where would you be today? Okay, and this is what will happen. So this is the breakdown, and as you can see, this is our initial investment. We've added a bit of money, of course. We will have right now 400. In fact, that's not true. Let me just run it one more time. It shouldn't be 50. So there you go, 54%, $54,000. So that's where we would be right now. So that's about 17% compound annual growth rate, which is really good. Okay, so starting point was 10,000. We've added no money since then. We only reinvested the dividends, and that's basically where we are right now. That's a very good return, 16-17%. Basically, that the S&P 500 normally returns what, 7 to 10% per annum. So right now, that's really good. Now let's look at, say we decided, you know what, we're gonna add a little bit of money every single month. So we will add contribution. Okay, we will contribute monthly, and what we're going to add is just $1,000 for a fixed amount for the next 10 years every single month, and we're going to adjust it, inflation adjusted, and we're still going to reinvest our dividend. We're not going to rebalance, so we're just going to leave it as is. Okay, and this is what you saw already, $405,000 for over 405, sorry, not 550. Okay, and from 10,000 plus the 10 basically £1,000 that you added, for every single month, that's where you would be right now. That's about 40% compound annual growth rate, which is absolutely ridiculous. So you're starting in 2014 around here, and every single year your basically money is growing every single year because you're reinvesting the dividends. You're actually adding more money to the portfolio, and that's where you will end up. Okay, so the couple of graphs basically kind of show you where you are and so on. But overall, that is amazing. That basically 40% in 10 years. Because remember, because you're adding that more money will generate more money. That's probably the compounding annual growth rate taking place. The compounding effect is taking place. Whereas in comparison, if we didn't reinvest anything else, if we didn't add anything else, we would be right now. So if we get rid of this, by the way, if we go back to none and just run this again, okay, you get your 16%, you know, 54, let's call it 55,000 US dollars, okay, which is absolutely amazing. So this is one of the reasons is basically the best thing to do is invest in high quality companies and leave them alone. And that's what I'm trying to do. And I'm gonna see how it works. If this works, inshallah, because so far it is working, and I will show you in a second. Okay, so you can pause the video, look at it from Sharia compliance side of things, but like I've always said to you guys, Visa has absolutely no issues when it comes to the business side of things, if that's what you're worried about. Now let's have a look at these companies in my portfolio. So I'm going to quickly show you guys, just to make sure to be transparent and everything. So the first one is here, as you can see, S&P Global. They've got that over £6,000 there, up basically 43% up right now when it comes to that one. Automatic data processing about 28% up, so basically up. Have had this company for quite some time. Basically Union Pacific is the other one, again 24% up, about over £5,000 there. Visa is there, another one there, another 45% up right now. Home Depot and 53% up. Again, is one of the companies that I've had for a very long time in this portfolio. I wish I could add more to it, but I can't, unfortunately, because I do believe it's a little bit expensive. But there you go. That's what I wanted to share with you guys today. If you like this type of content, please join us at the Patreon account where you get access to a lot of these things, inshallah, and you can become part of the community and inshallah hopefully get some, you know, feedback from the brothers and sisters that are sharing good practice every day. You can message me on basically through here as well, where I would respond as much as I can, inshallah, to you guys. Anyway, I'm going to stop the video here. Have a wonderful day. Assalamu Alaikum.